Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Fed officials explaining their views after a very divided October interest rate decision. Joining us now to discuss is Torsten Slok of Apollo. Torsten, good morning to you, sir.
Morning.
Super divided Federal Reserve based on the communication we've had so far from the committee following that decision. This line here from Governor Myron to us just yesterday, that we're a fair way away from neutral. I think we could get there a bit faster. How close are we to neutral?
Well, the key question here, of course, is are we doing monetary policy according to some framework with R-star or some forecast, or are we doing monetary policy according to data dependency? Because it's very clear that a lot of the arguments that are being laid out for more cuts, of course, is really dependent more on the forecast or is dependent on some framework about what do you think R-star is. So the discussion about R-star, which we now have had for many years, of course, is very clear. There's a lot of uncertainty. So with that backdrop, yes, some estimates are low. So you could argue that those are the ones you should be focusing on. But it's very clear that the divide really here among FOMC members in the last few days has been around, should we focus the policy decisions today on R-star and some forecast that we may have, or should we focus it on the incoming data?
Well, let's talk about the incoming data. How can we forecast anything if we don't really know where we are at the moment?
Well, we do have CPI, of course, before the last FOMC meeting, but what we also have is a number of indicators for the labor market are also still showing that things are actually still okay. If you look, for example, at the macro edge job announcement cuts data, that's still okay. The Challenger Gray and Christmas job cuts data is actually also still okay. If you look at ADP, job creation is also okay. If you look at Revilio Labs, also job creation, also okay. If you also look at paychecks, there's also link up, there's also indeed job openings. Taken together, all these indicators are not showing a labor market where the bottom is falling out. So that's why the conclusion from Jay Powell last week was very clear. Inflation is still around 3. The labor market is still okay. So with that backdrop, what is the argument for cutting rates, at least when you look at it from a data-dependent perspective?
The argument is that you are passively tightening, as we heard from Stephen Myron yesterday, because of the demographics and because of the fact that inflation is coming down. And with a labor market that's okay, but relatively fragile in certain corners, why not give them a little bit of support if you are above neutral to get back closer to neutral? What do you make of that argument?
Because there's also a broader discussion around, it's not only about the Fed funds rate, it's about financial conditions more broadly. And if you look at my Bloomberg measure of financial conditions, it still shows me that financial conditions are very easy. So in that sense, companies, especially in the AI space, they're not borrowing as a function of the Fed funds rate. They're borrowing as a function of equity prices. And given where equity prices are for the Magnificent Seven, that's very importantly coming a very significant tailwind still to the economy and still even to hiring, simply because we now have that equity financing is getting huge help from the fact that equity prices are still as elevated as they are at the moment.
You've done a great job of talking about the K-shaped market. And this is sort of the conundrum for the Fed. They've got this blunt tool of cutting rates. And there's this question of, does that help the lower income consumers and companies that are catering to them more than it really risks creating a bubble in the AI names and those areas where financial conditions are very loose? How do you weigh in on that?
That's exactly right. And that's why what becomes exactly critical, Lisa, is to think about what is the weight in aggregate consumption from the bottom 20% of the population, which is roughly around 8% of total consumption, whereas the top 20% accounts for 40% of total consumption, according to the Consumer Expenditure Survey. So because of that, it still is the case that when stock prices are up, home prices are up, and when interest rates are high, the cash flow for those who own debt, who own private credit, is still strong. So for those households at the upper end of income distribution, things are still looking good, and that's a very important reason why the consumer still continues to do well. And critically, it's not only a K-shaped economy for the consumer, it's actually also a K-shaped economy for the corporate sector. If you look at EPS expectations since the beginning of the year, Magnificent Seven, the expectation is that earnings will grow further, but for the S&P 493, earnings expectations have actually come down. Likewise, the same thing for profit margins. For the Magnificent Seven, it's going up. For the S&P 493, profit margins expectations have been coming down. So we're seeing more signs of the K-shaped economy, not only the division in terms of the consumer side, but also on the corporate side, where it's more and more the AI story that continues to drive everything.
Do you see limits to that trend?
Well, the key issue, of course, is to what extent on the AI story, of course, the AI companies at the Magnificent Seven can continue to deliver the earnings that are priced in at the moment. If there, for whatever reason, is any slowdown in earnings growth in AI, it will certainly begin to create some wobbles, not only in the data center build out and also, of course, the challenges on the associated energy side, but it will also begin to have some wealth effects, especially if we do get the correction that we've had some conversations about in the last 24 hours.
Yeah, just to think through this in the ultimate extreme, you need someone to have a job to buy the product you're selling. Like, ultimately, don't you? And the fact that we've seen some decoupling between employment and corporate profits, I just wonder how much longer that can persist.
Well, a very important part of that is indeed that immigration has been slowing down. So the Dallas Fed is now saying that the equilibrium non-farm payrolls is 30,000. So think about the ADP that came out last week. The monthly number was around 50, 60,000. So that means that suddenly we have that 50, 60. It's actually not too bad when you think about that suddenly the Fed is telling us that the new going rate where we should be is 30. So from that perspective, we can have a slowdown for immigration restriction reasons, also the 100,000 on the H-1B, that will slow down job growth and therefore still create a labor market that's just having slower growth in jobs, but not so much because the economy is slowing in GDP, but simply because immigration inflows are a lot weaker.
Torsten, if the Fed were to cut by 25 basis points, does that cause the K-shape to get wider or narrower?
So that depends on, of course, for the consumer side, if we continue to have a rally in the stock market, if we continue to have a divergence in asset prices going up further, then we will continue to see the K get even longer on each side of the leg. So in that sense, cutting rates is certainly something that normally boosts asset prices and therefore makes the wider K a distinct possibility.
Stay with us. More Bloomberg surveillance coming up after this.
It's election day here in New York City. President Donald Trump endorsing Andrew Cuomo for the city's next mayor as the former governor faces an uphill battle against the frontrunner, Democratic Socialist Zohran Mamdani. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, something that Lisa and I have been wrestling with throughout this morning. Is this election here in this city taking the temperature of the country, the mood of the country, or just taking the temperature of the Democratic Party? And which argument's going to win out as we head towards the midterms?
You know, it's fascinating. I think you said Donald Trump's name, 15 more times than either of the Democratic candidates in the race today, in the lead into here. And I think that just really exemplifies where the Democratic Party is right now. They're so bifurcated and so lacking in a cohesive message that they can really only be anti-Donald Trump. Now, for Democrats, that's a good thing because Donald Trump is a massive vote turnout machine. So for Cuomo, for Mamdani, they're both going to be taking exactly what they want, spreading it out to voters and making it all about Trump, which really speaks to the lack of comprehensive message that Democrats have struggled with since 2016, quite frankly.
That's the reason why I think, Henrietta, a lot of people think of this as sort of like a mini pre-midterms moment, especially given the fact that there are races in New Jersey and in Virginia and California. There's an initiative that people are going to be voting on about redistricting. How much are you going to take a big read-through in terms of what type of mandate President Trump has, what kind of vision gets the most voters for Democrats? How much is this taking the temperature versus idiosyncratic races with a number of very specific inputs?
The off-year elections, this midterm, is one of the best predictors of what will happen in the House of Representatives next November. It is an exceptional early indicator from New Jersey, Virginia, not just who wins, but what the margins are. And the reason that President Trump is so animated about the midterms, if you follow his social media feeds, it's been 48 straight hours of endorsements, is because he is very likely, Republicans are very likely to lose the House, just statistically, with such a tight margin. And that means, massive subpoena power for the House of Representatives next year if it is democratically owned. So it is incumbent upon President Trump to do what I just said he does best, which is turn out the votes, but in favor of the Republican candidates. He really needs to hold on to the House more than anything else. And it's going to be a very serious uphill battle that, statistics and history show he is very likely to lose. So California, Pennsylvania Supreme Court, Virginia, New Jersey, the margins are where wonks like myself will be watching just to see exactly what we should be looking for next year. Is it going to be a 7-seat margin in the House of Representatives, or are we talking like 30 seats? That's what this today's election can tell us.
How much are national concerns feeding into the local races, given the fact that the government shut down? There's a lot of dissatisfaction on a national level. At a local level, there is more engagement, an increasing amount of engagement from residents. Is there a divergence here, or is there a pretty clear correlation?
That's a fascinating question. I think it's different for each party. So in this cycle, the Republican Party has continued to be led by Donald Trump, and he's not on the ballot. And so what Republican staff and campaign operatives I speak with will tell you is that Republican voters are tuned out. When we saw the returns on the national election last year, people would go to the polls, vote for Donald Trump, and then leave. So the fact that Trump is not on the ballot this cycle, he's not on the ballot in the midterms, and he won't be next year either, the Republican Party is trying to figure out how can I backfill that dearth and that absence left by Donald Trump himself, the plain leader of the Republican Party, and get our voters excited for J.D. Vance, for Marco Rubio, for any of these local politicians. So you see this depressed participation on the Republican side because Trump is not on the top of the ticket, and that leaves a vacuum for Democrats to turn out. So really it depends on which party you're talking about.
Henrietta, I understand the temptation whenever we cover these stories to group people into very neat groups, Republicans, Democrats. But is there another group, another set of individuals that can't be put into one bucket, that are pretty fluid, and they're willing to vote for someone who's got a solution to their problem? And right now, the problem for a lot of people in this country, and it's persisted for a long time, is affordability. And those problems were exacerbated through the Biden administration. They're looking for solutions. It might come from the far left. It might come from the conservative right. Henrietta, I just wonder how much of a feature that's going to be in the elections through the next 12, 18 months.
Yeah, I think it's the biggest feature. You have 68% of the U.S. population that does not support the state of the U.S. economy and is very concerned about inflation and does not support the president's tariffs. So the president and his committee officials and cabinet officials are saying, give us another year. Let us bring prices down. But when voters are looking at their grocery bill, their electricity bill, the cost of a new car, whatever they're looking at trying to buy, it's all more expensive. It's all because of the tariffs, and they know that. And they are seeing manufacturing. They are seeing grocery prices increase, but not their wages. So the president ran on, theoretically an inflation-related campaign. Inflation was high after COVID, but it remains on the upper rise today as well. And you can see that again at the grocery stores most plainly. So when we go to the polls in November of next year, that's going to be paramount. Are grocery prices high? Is it our number one issue? Or do we care about immigration or crime or healthcare or other tertiary issues? But it's really always the economy, and the president is underwater with the lowest approval ratings that he has ever had in this term or last because of the state of the economy.
Stay with us. More Bloomberg surveillance coming up after this. Stocks pulling back from near all-time highs as Wall Street bosses issue a fresh warning on rich valuations and a possible drawdown. Joining us now to discuss, Henry Allen, macro strategist at Deutsche Bank. Henry, I feel like this is a move looking to find a narrative. How would you describe this to clients this morning? What is this pullback so far today?
I think this is actually just a kind of normal, regular pullback that you're going to get in any normal bull run. I mean, at the end of the day, you're not going to hit all-time highs day after day after day. We've had over 30 this year. So getting these kind of pullbacks, which in the grand scheme of this relentless bull run are pretty modest, we're still only around 2% off the all-time highs to the S&P, is to be expected. But, if we look at the macro fundamentals right now, they do remain pretty strong. Clearly, with the US-China trade truce, the risk of near-term tariffs has been taken off the table. We still have the tailwind from the recent Fed rate cuts, another 50 bips already this year, even if they don't cut in December. And actually, a lot of the activity data at a global level has been pretty good. I was struck, for instance, in Europe, that the flash PMI, actually, the composite PMI was at a 2-year high. So actually, the ISM manufacturing yesterday, yes, a little bit weaker than expected, but, I appreciate the data has been limited out of the US, but that has actually been the exception rather than the rule. And I think that fundamental bullish backdrop does remain in place.
Henry, at the same time, I think we have to take note when a stock falls on good news, not bad news. Palantir and the earnings from Palantir wasn't bad at all. If you go through the numbers relative to expectations, then you see the move this morning, and the stock is down by 6 or 7%. Does that speak to full valuations? What do you think that speaks to?
I think you always get these moments where single headlines can create a lot of fear. I mean, I remember back in early in the year, before the Liberation Day turmoil, we had the DeepSeek AI model released, and there was a very big temporary pullback in tech stocks that proved to be very short-lived. People thought this might be a new big narrative shift, and it wasn't. But, you know, thinking about those CEO warnings you played just before this, you know, if you think about what has generated, you know, 15% drawdowns for the S&P in recent decades, it's usually taken one of three things. One is a recession, which there's no sign of yet. The Atlanta Fed's GDP tracker actually at 3.9% in Q3. Another is fears of a recession, like we saw after Liberation Day, but you know, no one's seriously talking about a recession right now. And the other third component that has gone with that is Fed rate hikes. So a lot of the sell-offs we've seen in recent years, so 2015-16, late 2018, and indeed 2022 most notably, have gone hand in hand with Fed rate hikes. But you know, they're not talking about hiking anytime soon, and if anything, obviously with the new Fed chair coming in next year, the direction of travel remains pretty dovish.
We'll talk about the Fed in just a second, but it's not just the big Wall Street CEOs that are talking about this. I actually took more notice at a story that came out this morning that Michael Burry of the Big Short fame is shorting Palantir and Nvidia shares. And he's coming out and talking about valuations, but he's also kind of leaning into a narrative that an increasing number of people have talked about, which is this K-shaped market can't continue. You have to see some monetization of the software, of the hardware, in order to keep this AI trend going. Do you think there's validity in that maybe some of the winners need to take a pause and there needs to be a transfer in terms of stock market leadership?
I think to some extent there is, but I think a lot of the comparisons to the dot-com bubble are really quite over-egged at the moment. So, for instance, you know, the Nasdaq is up by 23% year to date so far. Now, that's very healthy. But in 1999, we had the Nasdaq up 85% that year. And in the final 7 or 8 months of the dot-com bubble, the Nasdaq literally doubled. So I don't think the gains we're seeing, you know, can really be compared to what we saw at the time of the dot-com bubble. And another key difference between now and then is back then, you know, a lot of the assumptions that valuations rested on was a belief that 4% growth, as we saw in the mid to late 90s, would continue forever. You know, forecasts from reputable people like the Fed were saying that would continue well into the 2000s. But then, as we know in retrospect, we had that downturn in 2000, 2001, and there was a recession. Whereas again today, you know, valuations are not resting on continued 4% growth forever. We're kind of in a 2.5% to 3% range, perhaps with some upside if AI productivity does lead to a boost. And again, there's no recession on the horizon. So clearly, if that macro picture changes and we do get a growth downturn, then I think that would take some of the underpinning away. But for now, you know, we're not seeing those relentless, remorseless gains that we saw at the time of the late 90s.
You talked about the other catalyst, the potential catalyst for an end to the rally, which comes from the Fed and a potential tightening in Fed policy. Seems like that is nowhere on the table, as you were mentioning. You did say that maybe inflation is underappreciated, and that's something that Deutsche Bank has been talking about quite a bit. What makes you think that, based on the ISM manufacturing, which was the opposite, based on the fact that there is this K-shaped economy that has put pressure on any additional price gains that we've seen in the consumer sector?
Well, I think there are still a lot of inflationary catalysts. I think the market has been a bit too reassured by the US-China trade truce we saw last week and some of the other recent data. But at the end of the day, for instance, tariffs, very still much in the picture. I know we associate a lot of the tariffs that have come in with April time, but actually a lot of the tariffs, for instance, the 15% on the EU and Japan, the 10% increase on Canada, the sectoral tariffs like copper, a lot of those tariffs only came into effect in August, and the data we've got only goes up to September. So that's still going to be a theme as we move towards year-end, the Q4 data, and into 2026. On top of that, we still have the lagged impact of all the rate cuts. Indeed, it's worth bearing in mind, the Fed have now cut rates by 150 basis points since September last year. That is the fastest pace of rate cuts outside of a recession since the 1980s. This is not a framework that we've been used to in recent times. You've got momentum there too. The activity data, you know, still proving pretty resilient, so that suggests demand pressures. And at a global level as well, you've got factors like the European fiscal stimulus coming in. So, you know, as I look around the world right now, including in the US, I think there's actually still a lot of inflationary catalysts on the table, and I think markets risk ignoring that on their peril, because if we do see inflation start to tick up again more than markets expect, I think the risk is we get a similar hawkish surprise to what we saw last week, where markets were surprised when Fed Chair Powell took that December rate cut a bit off the table, put it in some doubt.
Henry, I know that Deutsche Bank just re-entered a short position on 10-year treasuries and have a target of 4.45%. I'm just wondering, is that enough to continue the sell-off that we're seeing this morning in risk assets, given the underappreciation, as you've been saying, of inflationary risks?
I mean, that's an interesting question. I think that the key question, particularly as we move forward into next year, is do we get that re-acceleration in the economy? Because one thing I've been struck by in this post-COVID cycle is that consistently, particularly in the US, the macro picture surprised on the upside. So even in 2022, though we had the fastest Fed rate hikes in a generation, which previously had always led to recession, they pulled off the soft landing just about. Then in 23 and 24, we had stellar equity gains. The S&P 500 rising back-to-back 20% for the first time since the late 90s. So again, that macro picture has been very strong. And again, this year, even though we had genuine fears of a recession around Liberation Day, the biggest trade shock since the 19th century, again, the economy has been remarkably resilient. So actually, I do think there is upside potential for yields as we look forward to the rest of this year into next year. And actually, I'm struck that last year when the Fed cut rates, actually it was the point they were cutting rates that actually proved to be the low for yields. From then onwards, they picked up again. So I definitely think there's a valid case for that.
Stay with us. More Bloomberg surveillance coming up after this.
A record number of New Yorkers already casting early ballots for the city's next mayor. President Trump announcing his support for Andrew Cuomo, who is running as an independent, and threatening to withhold federal funding if front-runner Democratic Socialist Zohran Mamdani turns out to win. Whitney Tilson is a former hedge fund manager and was a 2025 New York City candidate in the Democratic mayoral primary. He joins us now for more. Whitney, good morning. It's good to see you.
Good morning. Thanks for having me.
Thank you for being here. What's at stake today?
Well, it's a big day for New York. I think there's going to be a big surge in turnout, and I'm glad to see New Yorkers are getting politically involved. Early voting was 4 times what it was 4 years ago. I wish that didn't favor Mamdani, but it probably does, as it did in the primary. But the polls show the race is tightening. It was 15 points, and now the latest poll, just yesterday, it's under 5 points. So it's not completely impossible that there could be a big election day surprise, though Mamdani's clearly up 5 is still a good place to be going into election day.
You're familiar with the headline on Wall Street that the capital of American capitalism is lurching towards socialism. Yeah. Does this tell you more about the mood of the country or the mood of the Democratic Party?
Well, and also it tells you something about the candidates. Mamdani is a gifted politician. He identified the key issue for New Yorkers is affordability, and he came up with some very clear, freeze the rent, free buses, free childcare, very easy slogans. And one thing I learned as a politician, if you want to win, promise the maximum number of people, the maximum amount of free stuff, and tell them they don't have to pay for it. And he nailed that, and he's been on message. And Cuomo thought he was going to coast to victory in the primary, and really didn't even campaign out there. And by the time I was raising the alarm in the late stages of the primary, it was too little too late.
It's simplistic, though, to say that it's just promising people freebies, and that's what got some of the attention. It's also that what Zohran Mamdani was talking about wasn't just the anti-Trump platform. It was the idea of trying to identify some of these needs. Have you been disappointed that the Democratic Party hasn't done a better job of crystallizing those issues and running on that and not an anti-Trump message?
Yes, very much. And I don't think it's just here in New York. We're seeing it. We're seeing it nationally. I'm a lifelong Democrat. I ran the Democratic Party to try and drag my party, back to the center, to bread and butter issues for people rather than social issues and just attacking Trump. And Mamdani, to his credit, hasn't spent a lot of time attacking Trump. That was not his. It was affordability and a few key ideas. And in the same way, from the opposite side, he's a little like Trump. Trump was, we're going to build a wall and Mexico's going to pay for it. And I don't think his supporters actually believed that, but it was a clear message on the issue that they cared about. And Mamdani took a page out of that book and has executed superbly. I got to tip my hat to him.
One thing that you do really well is that you're at the crossroads of Wall Street and the political scene. And I'm just wondering how realistic you think some of the threats are by your colleagues of leaving New York City if Zohran Mamdani should win.
That will depend on whether he governs as he has in the past few months, as he's promised to, sort of tacking to the center, and said, I will protect the Jewish population of New York despite his dangerous rhetoric in previous years. I will not defund the police, and to his credit, said he will keep Jessica Tisch. I'm going to embrace entrepreneurs and businesses as opposed to, government seizing all means of production, which is what's on his political party, the Democratic Socialists of America, says that. So I'm cautiously optimistic. hopeful, I would say, that if he is elected, he will try and govern from the center, keep us safe, and keep New York, the incredible center of entrepreneurship and finance and trade and all. But there is a risk that, a 34-year-old guy who's grown up with the rhetoric of the far left, if he governs as a radical, I think people will flee the city and businesses.
Elisa, it's already happening. You've been seeing it now for years. I think a great stat is that JP Morgan Chase now has more employees in Texas than it does in New York State, which 10, 15, 20 years ago might have been shocking to some people, but that's the reality of America in 2025.
A lot of it has to do with taxes. A lot of it has to do with certain business practices that haven't been as friendly. How much does this accelerate that move, as we've seen? And how much is Zoran Mamdani, if he does win, going to be sensitive to that, to want those people to remain an income base for the city?
It's not just making the city more competitive with global capitals, it's making this state more competitive with the other states across this country, which goes to Lisa's question. What's going to stop people from moving? Whitney, when you were going out there and campaigning, what are you campaigning for? What would you like to see change in this city and this state to make sure we attract the best of the best, not just around the world, but in this country too?
Yeah, well, it starts with public safety and not defunding the police. Defund and dismantle the wicked police are all things Mamdani had on his website. And I said, we need to do the opposite. We're at a 34-year low in the number of police officers, and we need 5,000 more police officers. I was going in the other direction on public safety. And then secondly, look, economic growth is the key to everything. It's the key to paying for all the things Mamdani wants. And I would love to deliver free child care to every New Yorker as well. It's that cost is crushing people, but you got to be able to pay for it. So under Mike Bloomberg, the taxes doubled. But that's because the economy doubled during his 12 years. Under de Blasio, economic growth slowed from 6% a year to 2% a year, and all of a sudden we're running budget deficits. So creating a business-friendly environment is critical, and unfortunately Mamdani's rhetoric is sort of the opposite, and rhetoric matters when it comes to making long-term investment decisions about where to locate your business, whether to invest in building and hiring people and so forth. That was a key part of my platform, but it turns out just affordability and promising lower costs in a few areas was the winning message this year, and Mamdani executed on it superbly. He was on message.
I mentioned JP Morgan. Jamie Dimon talked about Bill de Blasio, and he said something like, we survived Bill de Blasio, we'll survive this. Yeah. Is that too simplistic? No,
it's my model that my working scenario going forward is Mamdani will be de Blasio 2.0. Little left, too far left for me, but de Blasio did not mess up this city. New York is still doing incredibly well, and I'm actually much more optimistic on New York, having run for mayor and spent 7 months in every corner of the city. We're an incredibly rich, dynamic, entrepreneurial city, and I'm confident Mamdani is not going to drive everybody out and mess it up.
This is sort of a sensitive question, but are you surprised to the degree that the politics around the Middle East are driving voters in New York City to a large degree?
Not really, because New York has the second largest Jewish population outside of Tel Aviv in the world. It's about 10% of the population here. And my wife and children are Jewish. We've been members of Central Synagogue for 25 years. And Central Synagogue, anytime you go to services now, there are not just a few police officers. Like, there's paramilitary people out there protecting us. We have to go through metal detectors. It's a fortress because of these mobs and the rhetoric, the anti-Israel rhetoric that Mamdani is trafficked in. You don't have to go very far before it becomes anti-Semitic, and some of these people are committing violent acts against New York's Jewish community. So it's a big issue. It's one I hit Mamdani hard on during the primary. And again, to his credit, he has said that, job one for me is going to be protecting all communities that are under threat, especially the Jewish community. I'm hoping he delivers on that.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.